Okay, so we've looked at what returns can be achieved through the various different stock markets, the global market, the UK market, and indeed any other stock market on the planet. It's all in this fabulous data book which you have a copy of on enrolment into the online program. Now, there are two ways to invest in terms of styles. One is a passive style and the other is an active style. In other words, the active side, somebody's actually making decisions about what to invest in and where to invest in, how the investment portfolio should be set up. So let's just look for a moment at the two different styles and how they work. If I draw a line across and I distill investments into three main asset categories: stocks and shares, which I'll symbolise with an S; fixed income, which is gilts and bonds, which I'll say B for bonds; and property. And I know we could get into long conversations about commodities and gold and so on and so forth, but let's just say for a moment that we can distill it down into stocks, bonds and property. Okay. On the one side of the scale, we have passive investment management, a passive manager. Now, the passive investor or the passive investment manager will say that it's not. The passive manager will say it's not about forecasting because it's difficult to forecast. So the passive managers will say it's not about forecasting because that's a really difficult thing to do. The passive manager will lean towards having high levels of diversification. The passive manager will say that having lots of diversification throughout lots of different stocks and markets is the way to go because it almost puts a warm blanket around the portfolio and shelters it from things that can go wrong. The passive manager also says it's about keeping trading to a minimum because every time you trade the portfolio, we take money out of it. And finally, the passive manager also says it's about keeping costs low because every time you charge the portfolio another 0.5% or another 1% or whatever it's going to be, it just reduces its value. And that's the passive style. The other side of the argument is an active style of investing. Now, the active managers say that actually it is about forecasting. We've got really clever tools, we've got really clever intelligence, we've got really clever people who are able to tell where returns come from, and they'll make decisions on an active basis, whether that's daily, weekly, monthly will depend. But certainly there's some form of management on an active basis going on. And on that front, the active manager or active managers will say lower levels of diversification is the way to go because you don't want to spread the capital, the money, the pension, the ISA, the general investment portfolio around too many stocks. It's just going to be too heavy. So the passive manager will say it's about having a lower level of diversification. And by contrast, they will also say actually, because we're going to be getting in and around these asset classes on a regular basis, it's okay to have higher levels of trading and higher levels of trading costs because, frankly, we need to shift things around and we're going to have to make, constant adjustments to keep the portfolio on track and in line. And because of that whole approach, because there's obviously quite a lot to do, because there's lots going on, and you've got this rolling ongoing management, it's actually okay to have higher fees bolted onto the portfolio because frankly, sometimes you have to pay really clever people, a little bit more on an annual basis out of your pot to make it all work. And they are the two styles of investing. Now, here's the thing. I can tell you that one of these styles works and the other one doesn't in the overwhelming majority of cases. I have to caveat that by saying in the overwhelming majority of cases, one works and one doesn't work. Now, which one works and which one doesn't work in the overwhelming majority of cases will be revealed on the online program. But this is a big thing to watch out for. In fact, get this one thing wrong and it could be the difference between you having an enjoyable retirement and your retirement not working out quite to plan. So in the free session to watch, we talked about the two styles. We talked about the passive style and we talked about the active style. And we said that on the one hand, the passive style, no forecasting. It's about having, huge levels of diversification, buying all of the, equities, all of the stock markets throughout the global and emerging world. It's about keeping trading costs low. It's about keeping the overall portfolio fees down too. And on the other end of the scale, we have the active managers who think it's quite okay to have high levels of fees and costs and trading levies built into the portfolio, because you need to have, all of that going on to make it work in the most effective way. Now, here's the thing. All of the evidence and 25,000 or so papers and counting, stacks of data, stacks of research from the University of London, from Vanguard, from Dimensional, and so many other academic studies have proven that in the overwhelming majority of cases, if you follow the passive route, you'll have a successful investing experience. Whereas if you follow the active route, in the vast majority of cases, and it's reported to be anything from 80 to 90%, it just won't work. And that's because these people can't keep getting it right over and over and over again. Many investment managers in times past have done well for periods, and then eventually it comes all crashing down. So I'm unapologetically over on this passive side of the fence. And I believe if you invest using our style, we'll have a successful outcome. Over here, you might still have a successful outcome, but the chances are very heavily stacked against you. And let's just put some, fees into this whole thing now as well. With a passive style, I think all in, you're talking maybe perhaps in the region of about 1% a year. On the passive side, this is for the management, the funds, this is for everything. And I'm going to be kind because fees can be as high as 2.5% to 3%. But the total fees of following an active strategy can be closer to 2% than 1%. Now, if you've got a £250,000 pension or a portfolio that incorporates ISAs, investment bonds or whatever, if you've got £250,000 over a 3-decade retirement, over a 30-year window, just that extra 1% alone on a £250,000 portfolio, clearly £2,500 a year, £25,000 over 10 years and £75,000 over a 3-decade retirement, you would have paid in additional fees, in excess fees. That's a significant amount of money. It's lots of holidays. It's, seeing your kids through college and university, grandchildren perhaps too, or certainly making a difference in one way or the other. But it's not just £75,000. Because had the money been left in your portfolio on the passive side of the investing pendulum axis, it would have grown to something like 250,000, the same amount you started with. So that is the significance of just a 1% additional fee. If you think some active strategies and big networks out there are charging 2.3, 2.4, 2.5, which is very common, you can start to see how the fee differential makes an enormous difference. And by investing on our side of the fence, you won't suffer that.